One of the more common price analysis tools used by traders is Fibonacci. In today's video, we'll talk about the most practical 10 uses of retracements, the best practices for building a trading strategy around Fibonacci, and other trading tips to find high probability signals using this tool. Number 1. There must be a visible trend, otherwise Fib levels won't have a meaningful impact on price movement. No matter how often you use Fibonacci, what's most important is to use it correctly every time, and choosing the correct price swing for placing your Fibs is one of the main problems when using it. Fibonacci is an effective method, but you must place it on the swing that makes the most sense for the current market conditions. The most important aspect when using Fibs is the presence of a trend. There are two primary ways to solve the problems with drawing Fibs on the chart. First, focus on trend and momentum, and second, using the logic price swings for placing the Fibonacci tool. Please remember this, Fibs don't work well in consolidations, corrections, ranges, and sideways movements. Number 2. Don't use the Fibonacci retracement tool on very small price moves or shorter timeframes. Applying Fibonacci retracements over a short timeframe is ineffective. The shorter the timeframe, the less reliable the retracement levels, making it very difficult for the trader to really pick and choose what levels can be traded. Not to mention, in the short term, spikes and false breakouts are very common. These dynamics can make it especially difficult to place stops or take profit points, as retracements can create narrow and small confluences. So try to focus on the larger timeframes when you apply Fib levels. By keeping tabs on the longer term trend, you can apply Fibonacci retracements in the correct direction. Further, if you use the Fibonacci retracement tool on very small price moves, it may not provide much insight. The levels will be so close together that almost every price level appears important. Number 3. Apply Fibonacci retracement levels on the correct price swings. Using a Fibonacci retracement tool is subjective. There are multiple price swings during a trading day, so not everyone will be connecting the same 2 points. The 2 points you connect may not be the 2 points others connect. Here's how you correctly apply Fib retracements. You determine the dominant trend. You identify the swing high and swing low before drawing the Fibonacci lines. In a bullish trend, draw the Fibonacci from the swing low to the swing high. In a bearish trend, draw the Fibonacci from the swing high to the swing low. And you will be drawing the Fibonacci tool from the wicks of the swing highs and lows. At the very basics, the clearer the swing low, the clearer the swing high, and the clearer the trend between these 2 points, the more accurate the Fibonacci retracement will be. Also very important, don't try to force Fib levels. The best and most helpful Fibonacci retracements are those where you don't have to look long on a chart. Number 4. Shallow versus deep retracements. In trending or impulsive markets, the Fib levels indicate precise levels where there is a high chance of the market turning back in the direction of the trend. Basically, Fib levels provide areas of interest to watch on pullbacks. There are 2 main types of pullbacks using Fibonacci: shallow and deep retracements. If you correctly analyze the strength of the trend, you will have high probability areas to take trades. Once a trend has clearly established itself, then you'll often see shallow pullbacks to the 23.6, 38.2, and 50% Fib levels, which are very typical before the trend continues. So when the trend is strong, pay attention to these Fib levels. Price will make a deep pullback when a trend is not clearly established. In those cases, price can make multiple ups and downs, which will test the bottom in an uptrend or the top in a downtrend, but without breaking those levels, which would invalidate the trend. you will see deep pullbacks to the 61.8, 78.6 and 88.6 Fib levels. If the price retraces 100% of the last price wave, that may mean that the trend has failed. Number 5. The Golden Ratio Retreat Strategy. The 61.8 level is called the Golden Ratio. Here's how the Golden Ratio Retreat Strategy works. In this example, we found this downtrend and applied the Fibs. If the price moves up above the 50% retracement, but doesn't close above the 61.8 Golden Ratio, look for a bearish entry. It's okay for the wick of the candle to break the 61.8 line as long as the price closes below it. As the price bounces from the 61.8 Golden Ratio, look for a possible reversal move back down to the 38.2 level. If the price breaks the 38.2 level, the 23.6 may be its next hesitation point. If that doesn't hold, expect a possible 100% retracement back to the zero line. These levels are good potential places to consider scaling out of the trade. If the price never gets higher than the 61.8, then you can set your initial stop just above that line. If the price went higher than the 61.8, then you could set a stop above the high of the candle that broke the level. If scaling out of the trade, consider moving the stops to the next Fib level as the targets are met. Number 6. Combine multiple Fib retracements to create Confluence. Fibonacci Confluence is essentially combining multiple Fibonacci levels to find clusters where these levels align around the same area. This example reveals an area of confluence formed by the 50% retracement of the AC wave and the 78.6% retracement of the BC wave. In this other example, price found support at this area of confluence formed by the 50% retracement of the AC wave and the 78.6% retracement of the BC wave in this daily chart. This is one of my favorite trading strategies using Fibonacci because it leads to high probability setups. Number 7. Confluence with moving averages. Fibonacci can provide reliable trade setups, but not without confirmation. Applying additional technical tools like moving averages will support the trade opportunity and increase the likelihood of a good trade. Fibonacci and moving averages work well together because both tools are very effective in a trending environment. First of all, using moving averages will help you to determine if there is a trend. Second of all, moving averages also act as dynamic support and resistance levels in a trend, which means that a moving average adds confluence to a Fib level. For instance, if a 50% Fibonacci retracement and a 200 EMA align at one spot on the chart, then this is called a trading confluence. There is a combination of elements joining together at one point on the chart. When a Fib level and a moving average are confirming a spot on the chart to be of importance, then the likelihood of the price reacting to this level increases. Again, this is very effective because by combining Fibs with moving averages, you remove the weaknesses of each tool when used separately. Number 8. Confirm Fibonacci levels with volume. As a trader, when you see the price coming into a Fibonacci support area, the biggest clue you can look for is the volume to see if that support will hold. Notice how the stock had a number of spikes higher in volume on the move up, but the pullback to the support at the retracement saw the volume decreasing. This doesn't mean people are not interested in the stock. It means that there are fewer sellers pushing the price lower. This is where buyers come in and accumulate shares in anticipation for the rally higher. High volume after the rejection of a Fib level represents a very good sign. Number 9. Look for divergences at Fib levels using RSI, MACD or Stochastic. Now, rather than blindly entering into a trade because it hit a particular retracement ratio, you need a confirmation signal that the price is likely to turn. I prefer adding a momentum oscillator like the RSI, Stochastic or MACD and look for a divergence signal forming around Fib levels. These are leading signals, by the way. Here we have a downtrend with the Fib levels added to the chart. The first level, the 38.2 level, was broken with ease. However, we can now see that the 50% level is providing some resistance. We can confirm the slowing momentum with the RSI. The RSI is showing divergence, which is a bearish signal as well. Price makes higher highs, but the oscillator makes lower highs. This means momentum is slowing, and slowing momentum into a resistance level is a good recipe for a trading opportunity. In this example, we have an uptrend, with the MACD indicator showing a hidden divergence. Here, when the MACD hidden divergence appeared on the price chart, the price reached the 38.2 Fib level. When price tested this Fibonacci retracement level, this would have been a good level to enter in the direction of the main trend. Number 10. Analyze candlestick formations around Fib levels. Analyzing price action at Fib levels represents another effective way to take signals. In this case, traders wait for a candlestick pattern to occur at the Fibonacci level instead of only anticipating a price reaction at the Fib level. In this way, the candle pattern confirms the response of the market at the Fib level. Generally speaking, these candlestick patterns combined with Fibonacci levels tend to work better on longer time frames. When price reaches a Fib level, you look for a rejection candlestick that has formed at or near that level. The three types that are of most interest will be the hammer candlestick, which is often seen after a bearish price move, the shooting star candlestick, which is often seen after a bullish price move, and the engulfing pattern, which can either be of bullish or bearish variety. These candlestick reversal patterns are quite powerful and can foretell the end of the retracement move. As always, if you learned something new and found value, leave us a like to show your support, subscribe to our channel and hit the bell icon to stay in touch when we release new videos. Until next time.